When you look at your mid-year outlook for economies, Joyce, is it a bit more positive or less positive than it was, 2 or 3 months ago?
It's definitely more positive over a 1 to 2 month view than it was a few months ago. The labor numbers, the employment numbers have been better. And what we're seeing is, we had a synchronized downturn. So we're seeing at least the partial V shape back up. But I think the 3 to 6 month horizon is really more of the question that we're looking at and that we pose in our mid-year outlook. We still see GDP almost 4% below where it was pre-pandemic at the end of the year. But you still have fiscal support coming online. The income support is still there. That will begin to roll off in the fourth quarter of the year. But over the next 1 to 2 months, what the data is telling us, and we're looking at a lot of high frequency data, is that the numbers are going to remain pretty strong, on this V-shaped rebound on the consumer spending side. So I think you could still have a little bit more momentum here, but watch out for the fourth quarter.
Joyce, what are you expecting consumer sentiment to do? I mean, until we get the animal spirits back or consumer sentiment really back and firm, is there a risk that the economy wobbles?
There is a risk that the economy wobbles, because what we have seen is that if you take a look at private labor income, that's contracted by 1/3. But you've had all of these packages and the stimulus like taking care of about, at least 20 percentage points of that. So I think there are going to be questions as we get into the fourth quarter of the year. But you had, a historic downturn, a second quarter that, went down by 35%. So it's not surprising that the third quarter, the numbers are actually going to look much better when you go from this complete lockdown to a partial opening. But we do see that whether it's a stubborn first wave or a second wave, it's not going to go away. So you're not going to be back to full recovery. And we also see that some of these income supports are not going to last forever. So we're looking at more risk as we go into the end of the year. But that's not the next 1 to 2 months. Over the next 1 to 2 months, I think you could see VIX actually come down more from here. You can also see that there have been, a few more surprises, as far as the GDP growth numbers. And, China's been leading some of that. We have seen there that China is actually looks to be almost close to a full recovery.
Joyce, good morning from New York. I'm fascinated by what you and JPMorgan think is Mr. Buffett finally acts, this on $9.7 billion large. To me, it's just simple. Money costs nothing. Everybody's got to figure out what to do because there's not going to be a revenue growth out there. Are we ready for a Buffett-initiated M&A frenzy?
Well, you're absolutely right that money costs absolutely nothing. So if you just take a look at our negative yield monitor, where we look at just the negative yield on government debt, I mean, you've got about 32 trillion of debt, 69% of global government debt now that has less than a 50 basis point yield. So that's making stocks look very attractive, even with all of the risks that we're talking about. So just having and I think there's no there's no indication in sight that you're going to have to change the strategy over the near term. I mean, if anything, the market is looking at more fiscal stimulus that's still coming online. In the emerging markets countries, more easing that's occurring as well, and that is actually making us look at equity markets and whether you're seeing a shift over time from 80-20 to more of a 60-40 ratio.
Joyce, I'm absolutely fascinated how M&A types rationalize the acquisition of a 28 multiple, 4% revenue growing company, or maybe a 32 multiple as well. I mean, stocks are fully priced in many sectors, okay, fine, and yet we're all talking about M&A activity because money costs nothing. How does a CFO rationalize the acquisition of a 28 multiple PE?
Well, I think you're absolutely right. Money costs nothing. So if you take a look at just how corporates can raise debt, now you've got, on the one hand, on the corporate side, the default rate has been rising. It's over 6% in the high yield market. That's a 10-year high. But you also have that you're going to see all-time record issuance in the U.S. corporate bond market, $1.6 trillion. So there have been downgrades. I mean, we've seen 11% of U.S. corporate high-grade debt downgraded just since the beginning of the year. But you also have that companies are able to come to market and they're trying to plan ahead for the longer term. And I think that's what the market has been focused on, is that, is this period, they're trying to put a buffer into place right now.
Joyce, where will the... Yeah, go ahead.
And tapping the markets. The fiscal deficit, though, is really something that should be talked about more. I mean, we're looking at a fiscal deficit that's going up to about 13.8% of GDP on average when you look across the developed countries.
Joyce, when you look at some of the scarring left, by the crisis on the economy, where do you think the most fundamental scarring will be?
I think that you will see that unemployment still, I mean, we were at a 50-year low. The unemployment numbers have surprised, but are you still going to see unemployment at close to double-digit levels? And that then relates to where is private labor income, unemployment. You also will see more downgrades going to junk status. We see about $300 billion of BBB minus debt is still on negative outlook, and that's after having already $160 billion downgraded already. So there are longer-term consequences for this. But over the next 1 to 2 months, what the market is assuming is a couple of things: that the second wave will be there, but you're not going to go back to the lockdowns that we had. They're assuming that the accommodative stance and more stimulus is here, at least over the short term. But you will have in the fourth quarter more concerns about the U.S. election outlooks, more concerns about whether they have to extend this income support or what happens when it does roll off. But for the time being, what you see is that corporates see a real point to take advantage of coming to the market at spreads that are really close to all-time lows, and that what you're seeing in the equity markets too is that there's still positioning that's relatively supportive. Positioning is probably at the 25th to 30th percentile right now, and that's also one thing that is propelling the market.